Hello and welcome back to The Note, coming to you from London in the old format for the rest of this week. Today we're going to be talking about pensions. Now, many think that the forthcoming end of QE, the predicted rise in interest rates, could be a problem. But pension fund managers are emphatically not among them. For them, QE has been a very serious problem. With me now to discuss quite why that is the Chief Executive of Create Research, Amin Rajan. Amin, thanks so much for joining me once again. Now, you've done another big round of research on pension fund managers for Amundi Asset Management, and I'd like to take you through some of the results. If we take a look at the first slide, you can see that they overwhelmingly seem to regard QE as a form of financial repression and as an opaque tax. What do they mean by that? How can that work?
Financial repression in the sense that what QE has done has kept interest rates artificially low, and it's also trying to stimulate inflation. And the whole idea is really that this will bring about an arbitrary redistribution of wealth from savers to borrowers. And in that sense, it is financial repression. The reason why it's acted as an opaque tax is, first, QE has forced plan sponsors to make extra injections because the deficit levels have got really quite out of hand. Secondly, the very low discount rate has vastly inflated the liabilities of the pension plans.
So it's just made it prohibitively difficult to offer standard final salary or defined benefit plans.
Absolutely. So, for example, if you take top 50 companies here in Europe, their pension deficits have remained stubbornly at 70% since 2008, despite a very hefty increase in equity valuations.
So a 70% deficit means they can only cover 30% of their current liabilities that they owe to their members, to their pensions?
No, 70% deficit basically means they can cover 70% of their liabilities, but they can't cover the remaining 30%.
The remaining 30%.
Yeah.
Quite an alarming number.
Yeah.
Let's now take a look at these numbers in a little more detail. Everybody seems to think it is creating a problem for their funding. Can we explain, almost 70% say that this means they need to reconsider what a risk-free bond is. Okay. What's that going on about?
Now, pension plans are subject to, as you know, what is called a prudential planning regulation. Under that, what they have to do is really to produce long-term plans about what their assets are going to be, what their liabilities are going to be, and as a part of that, they have to make an assumption of what the risk-free rate is going to be. Now, as a result of QE, nobody believes that there are any risk-free assets left, because, for example, if we look at 10-year US Treasuries, these were supposed to be the most risk-free assets.
Right.
But it doesn't really share three key attributes of a risk-free asset. The first one is that it's not in the lowest pecking order of investment returns. If anything, it's notched up much higher returns than the risky assets. Secondly, it's supposed to have a zero difference between expected rates and expected returns and actual returns, when in fact there's a huge difference between the two.
Wild volatility in bonds in recent
absolutely
years, yes.
Wild volatility as well. And thirdly, they're supposed to be uncorrelated with risky assets, when in fact what we found is that correlation between them and other asset classes has been rising, particularly in the down markets as well.
So emergency low rates have basically hit at the very foundations of what it is to manage a pension fund.
Yeah. Now, this risk-free rate, it really is the most cardinal assumption that they have to make in the prudential planning regime. And at the moment, this current situation has reduced everything to guesswork. Everything is a shot in the dark for them.
Which is very discouraging when you think that what we're ultimately talking about here is whether people are going to have enough to live on in retirement.
That's right.
Now let's take a look at one more slide. There's much more where this came from. This is what people in the pension world are having to do in response, and it's a horrible list for those of us who haven't retired yet.
Yep.
Why are they raising the retirement age, and what are the impacts, I suppose, most importantly, of giving up on defined benefits, of shifting from DB to defined contribution?
Yeah. Raising the retirement age does really have a huge impact on the finances of plan sponsors. For example, raising the retirement age by 1 year reduces liabilities by something like 3%. So that really makes quite a lot of difference to their overall contractual liabilities. As for the shift from DB to DC, this is almost irreversible. If you take a UK example, 10 years ago, only 12% of newcomers into a company were not entitled to have DB plans.
Really?
Yeah.
Now That's extraordinary. So this is now a real sea change. That
Yeah, and now that figure has
sadly
gone up
can't
to
offer.
74%. So 74% of new joiners are not allowed to join the DB scheme.
Final question. Is it healthy that people are now having to make their own decisions in defined contribution plans and taking their own risks?
Well, it's not, because really, quite simply, when you shift the risk from from corporates to individuals, you are shifting risk from people who could manage it to people who don't understand it. And thinking of individuals as a kind of a financial planner is really something which is so out of keeping with what the reality is. For example, if you look at the amount of undersaving that takes place in the DC plans, it's absolutely massive. The going rate in the US is about 8%, when in fact it should be somewhere in the region of 18 to 20%. The best DC plans requires a saving rate of about 22%, and we're miles away from that.
Okay, I mean, thank you very much indeed.
Thank you.
That was a deeply depressing overview. Plainly, however, we can see that the era of financial repression of QE has had lasting negative effects. Obviously, it's very sad that companies are no longer able to look after their employees in the way they once were, and maybe the situation will improve at least a bit if rates start to rise.